In the headlines lately, this is typically on a national basis, but you see these sort of articles about things are overbuilt in certain markets. There's so much supply. We've never had this much supply since there was an article that said since the Nixon administration, and that's fine. But all real estate is local, right?
Today on the show, I have the pleasure of speaking with Michael Voulgarakis. He's a seasoned expert with over 17 years of commercial real estate experience in underwriting and asset management, and Michael oversees operations, underwriting and capital raising and investor relations at Southgate Ventures. I'm really pumped and excited to have him on the show today to share his incredible insight and knowledge. But enough out of me, let's get him out here. G'day, Michael. Welcome to the show. How you doing today, mate?
I'm great. I appreciate you having me.
Can you rewind the clock and tell me how you made your first ever dollar as a kid?
The first dollar was sweeping up construction sites. My father was a home builder. I was the, cheap labor, if you will, and I would follow tradesmen around, do whatever they needed, either sweep up behind them, pick up pipe clippings, haul shingles up to the roofs, haul bricks, paint siding, whatever needed to be done. So that was the first step into real estate.
Doing the sort of hard yakka, as they call it in Australia, about being on the tools, getting the calluses on your hands, understanding just the back-breaking work it takes, it really puts you up for success, I think, in terms of how you value a dollar. Going and doing hard yakka work, hard labor isn't easy, and really sort of sets, particularly young kids early on. I benefited from it when I was growing up, doing that sort of manual labor, and it put me on a path to understanding how to work and work smart, not harder. So with that being said, what is your story behind you as Michael coming into the real estate world? I'm sure you just didn't fall straight into it. What was that story look like?
No, I didn't fall straight into it. I ended up going to college, getting an undergraduate degree. I worked in sales for a few years. I came across a listing one day for a condominium. Just sort of, in my early 20s, I just saw this unit that was for sale. I said, oh, I know that area of town. And wow, that seems really cheap. And I ended up buying that condominium. I ended up renovating the entire condominium with my own two hands, with the exception of doing the major electrical work. I don't trust myself to do that. And, I lived in the unit for 2 years and sold it and made a hefty profit. I can't remember at the time what you were allowed to save or not pay tax on as far as profit goes, but I think it was maybe $250,000, right? I didn't make that much, but if you live in a primary residence for 2 out of the previous 5 years, and you're single, and you make up to $250,000 of profit, you're allowed to take that money and not pay any tax on it. If you're married, it's a $500,000 profit allocation. I'm not sure if that law is still in effect today, but it was when I was in my early 20s. I took advantage of it. I said, wow, I just made more money in living in this, buying this unit, fixing it up, living it, and selling it than I did in my annual compensation for the company I was working at. So that's where I really got bitten by the bug.
How long did it take you to make the leap into real estate full time?
It took quite some time, actually. Admittedly, I took a route that was a little bit more circuitous than I could have taken. What I ended up doing is buying a number of other condominiums via an off-market strategy, flipping those over prior to the Great Recession. And then I said to myself, I want to buy an income-producing property. My father wasn't from that world. I didn't get an education from him on that. And I realized, this is a lot of money out of pocket. It's an illiquid asset. I really ought to know what I'm doing here. At that time, I decided to go back to graduate school. So I went back to New York University, got a master's degree in commercial real estate finance, and took my first job in New York City in real estate. And I had various jobs from underwriting on CMBS desks to underwriting bridge loans for distressed properties after the Great Recession, as well as asset management. And all the while sort of looking for the entry point, if you will, to start investing. Investing in New York City is incredibly expensive on a price per pound basis. And the laws are quite intimidating, the tenant laws, that is. And I didn't want to start that way. I just was not, me and some of the colleagues I had, we didn't have the financial wherewithal to go buy a 20-unit building in Manhattan or Brooklyn. But of all things, my partner was a colleague of mine at one of my jobs, and we decided that we were going to start investing in Seattle, Washington, across the country. And we did that because we recognized that the growth of tech, biotech, aerospace jobs in the Seattle market, people were going to be very highly compensated. And we looked at the price per unit, price per square foot of properties that were being sold there, as well as homes, single family homes, condominiums. And we compared that to other West Coast markets, San Jose, San Francisco, most notably, also LA and San Diego. But really, we were competing against other tech markets, and we realized, wow, these properties are really very inexpensive compared. Not that we ever thought that the Seattle market is ever going to reach the San Jose or San Francisco price per unit or price per square foot, but we saw so much arbitrage there, so much room for growth that we said, yeah, we're gonna start this journey there, and we ended up flying out there, buying a property, and it snowballed from there.
That's awesome. That's a great story in looking at other comparable cities and seeing the growth. So my question is, how did you identify that the tech, biotech, all that sort of stuff was happening, particularly if you weren't living in that city and understanding the day-to-day's activities of what was going on, companies moving there, et cetera?
Great question. It's a combination of the job experience that I had when I was an underwriter doing bridge loans typically it was on distressed multifamily assets. We were making these loans all across the country. So I had exposure to a lot of the major markets and some secondary and some tertiary, but I had a number of projects that I underwrote in Seattle. Combine that with my partner who has relatives in the city, and he had a better sort of ground level understanding of what was occurring there, and then tack on the resources that we had to do research. We were at an institution, we had so much research at our fingertips. We could easily research things, slice and dice data. And it was that combination where we said, wow, these companies are paying how much, and the growth is this much. And we recognized there was also for a value add play, it had a very high number of properties that were of an older vintage that had not traded in a very, very long time, right? We're looking for low-hanging fruit. Is there, you can like a market, but if everything's been turned over in the past 5 to 10 years, your chances of finding something with a lot of meat on the bone, as they say, is lower. But Seattle has a lot of those older properties. Yeah. And that's what we decided to move forward with that market.
Interesting. You mentioned slice and dice data. What data were you specifically looking at for the listeners? So that and how can they get their hands on it? Because maybe some of that data is not available publicly, but I'm sure most of it would be that you like to look at and say, okay, this is why I want to invest in this specific market.
There are quite a few of resources that are prohibitively expensive, right? That we had access to. So, I'm not going to go into those. But there still is an incredible amount of data that is given away for free by those large companies that make you pay $10,000, $20,000 a year for the data. Yes, it's going to be a little thinner. It's not going to be as in depth. But between that and reading, the Seattle Times, which is the local newspaper, the Puget Sound Business Journal, which is another trade rag, they report on every single city in the country. And also, you can get some free reports from major associations, such as the ULI, which is the Urban Land Institute, to get a gauge of where a market is in the property cycle. Are they in an expansion mode, maturity mode, declining mode? What do other investors think about that market? What markets do they think are good? What markets do they think are bad or middling? I could spend a long time rattling off different types of sources. I think the thing to do is get on some trade rags such as Globe Street, which is globest.com, things like that. And you'll start to get access to resources that you perhaps didn't even know existed. And also other blogs as well, or real estate blogs are certainly a big help in figuring out, hey, what resources are available to me without paying a fortune for them.
Yeah. Well, you've established in a market like Seattle, you've been buying there for such a long period of time, but you haven't moved on. You haven't gone elsewhere. So now talk about the strategy of like, you identified this market all these years ago. You got in at a good price. You saw the good arbitrage between, say, a San Jose and Seattle, or LA and a Seattle. But now you've been in there for so long, that's caught up. Like, I know people who moved to Seattle and, they work for Spotify and they work for all these big companies, and the golden gem that was, in the rough is not there anymore. So how do you continue to be able to find deals now, all these years later?
Great question. So there still is a very large amount of assets that have not traded in the past 15, 20, 25 years. And I'm speaking about the city itself, right? The suburbs are slightly different dynamic, but within the 3 counties that surround Seattle, there are thousands of properties that are owned by either a mom and pop owner or a small shop that maybe they owned a few properties. And what we found is, to buy a value add property that has some room in it to increase value and to increase your net worth, they typically come from long-term owners that have not been putting any capital expenditure money back into the building. They're what we like to call, they're eating the income, right? They're taking the cash from the property. They're paying their grocery bill with it. They're paying their mortgage. They're going on vacation, etc. None of that money goes back into the property. So what happens? You have a property with dated units, right? If they haven't been updated in 20 years, lots changed since then. The exteriors are tired. There's moss growing on the roof. The parking lot looks gross. They're just not the most attractive properties. So there is an incredible amount of those properties in that region. So those opportunities still remain. And with the baby boomers, retiring or passing on, this is just a fact of life. There are many opportunities where they say, you know what, I'm old enough. I bought this property back in 1985. I bought it for $500,000. It's worth $8 million today. What am I waiting for? Let me cash out and let me make my family happy and not squeeze every penny out of it, and let it go to someone else to improve. Or, if they pass, there's estate sales where the heirs don't live in the area, or they're not real estate people. So those opportunities are still very abundant in the market.
With today's values that you're now buying at, yes, you want to identify those undervalued pricing, but I'm sure you're within spitting distance of probably the right value for the market. Are you still seeing such a big uptick in rents, or just improvements in what potential rents you could get by doing good improvements, that it still makes sense even in such a hot city like Seattle?
It's a bit of both. I'll talk about the rent growth and what we've seen in the city. Over the past 10 years, the average compound annual rent growth in the Puget Sound region is 4.6%. So that's year after year after year, 4.6. Now, that's not, what is it? What's the phrase? Past performance?
No indication
past
of future
results. Exactly. No indication of future performance, right? So that being said, what we've experienced through the pandemic, we were bracing for bad times like everybody else. Rents did dip a little bit, right? Some people left the city, demand softened a little bit. And that happened in 2020, early 2021. And then the middle of 2021, things just went haywire in a good way, where people started moving back in, rent started shooting up. We certainly surpassed 4.6% of rent growth in 2021, 22, and 23. And what we see now is in the headlines lately, and this is typically on a national basis, but you see these sort of articles about, things are overbuilt in certain markets. There's so much supply. We've never had this much supply since, I think there was an article that said since the Nixon administration. And that's fine, but all real estate is local, right? And because Seattle is a land-constrained market, it is 2 peninsulas that are surrounded by bodies of water. It is difficult to construct units there, right? It has a lot of regulations. And yes, there's a lot of apartments coming online, but the permitting has fallen off a cliff that happened in 2023 as soon as interest rates started to rise. So what we expect to see is let's call it an average rent growth, 2-3% over the next year. And maybe it softens while Class A units come online. But after that, in 2025, 2026, I think something like 80% of permits were not fulfilled or didn't move forward. So you're going to see a dearth of new construction, which is just going to increase demand for existing units. So what that rent increase will be, we don't know. But to satisfy the demand on a county level, King County, which is where Seattle is, they have to build 17,000 units a year between now and 2044. So the next 20 years. The average over the past 10 years has been 7,500 units. So a massive gap in what is projected to be needed versus what has been built to date. So even with a bump in new deliveries in 2025, we still think there's going to be still a very large demand supply imbalance in our favor.
It's interesting you bring that up because I think a lot of people are pointing to this new supply that's come online, everything from Seattle to LA to Phoenix, where we are active in, to Austin, Texas, all the way through to the Carolinas and Florida, that they're saying that permitting has come to a grinding halt. And I believe that, and I do believe that. But I think you can't say that I think the big thing that's come to a grinding halt is because the numbers don't make sense, the financing doesn't work. But there will be a readjustment if interest rates do stay higher for longer, which means either land prices come down or we see, cost of construction maybe come down a little bit, cost of labor. But that also takes time to flush out. When will things start to get back on the tracks again from a permitting and a construction point of view versus a existing ownership? And I think we'd all like to think as existing owners that there's going to be a shortfall in the future, but you still got to take it with a grain of salt that real estate, you can do money, you can make money in any market. You just got to understand the game, the rules in which you're engaging by. And the last sort of 12 to 18 months with the Fed going up so quickly, we haven't been able to understand those rules of the game. Thus, pricing hasn't adjusted as such. It's slowly starting to adjust, but it is interesting that that's a very big narrative a lot of people are talking about in the multifamily space here in the US, that yes, pricing has been whacked. If you bought in 21, 22, your asset value is probably low right now, 20 to 30%. But, hang on for a couple of more years. There's going to be, this sort of gap in the market where new supply hasn't come online for, say, 2 or 3 years because of high interest rates or because of, slower permitting. Then your asset will be worth more in the future. You can sell it and make a profit or get your investors' money out, whatever it might be. So now quickly, as we pivot towards the end of the show, you are on the East Coast and you invest on the West Coast. So how do you maintain control and what does your role look like in the company in order to make sure that you're, still looking at the right deals, you're still talking to the right people, even though you're, pretty much, you are across the country?
My partner lives in Seattle. It is a major component of our success, admittedly. I know the market well. He knows it even better than I do, right? Because he's been living there for almost 10 years. He knows the streets, he knows the players, he knows the brokers. His knowledge is just more in-depth about the market. So what we have sort of set up to function properly is I handle all the operations. So for the most part, capital raising, I oversee, our CMO, CTO, CFO, bookkeeper, and my partner oversees the construction management, the maintenance, and the property management. Now, where we really come together is on the underwriting of deals and the negotiation of the price and the closing, refinancing, and disposition. We share those responsibilities. I will typically be the one to make a first pass at the underwriting, send it over to him for discussion, and we go from there. And it's been a system that has worked very well for us over the past number of years.
No, it's great, and it's good to have people understand you can run companies from afar. I co-founded a company that was based in Texas. I had a local business partner, boots on the ground. I was in LA. I was doing more that exactly sort of similar role to what you're doing. And yeah, it works really, really well. You always got to find that boots on the ground to help you and have the yin to your yang in terms of partnership. And I think it's really, really important for those people starting out listening to this episode that you can do it in other markets. You've just got to be able to find the right people to partner up with. So kudos to you. So now now as we pivot towards the end of the show, what's the plan look like for 2024 and beyond? And I'll ask, did you see a bit of a slowdown in 2023 in terms of transaction volume and raising capital and all that sort of stuff?
Absolutely. I think what has served us well is that, my partner and I both have been working in this industry for, over 15 years. And, having gone through the Great Recession, when the Fed started raising, we said, okay, well, this is the beginning of the end of the current cycle. No one knows what it's going to look like. You just have to, keep your eyes glued to, the Wall Street Journal for the most part and follow the economy. And we took the time to sort of improve our operations and retool and become better operators. And we weren't focused on acquiring anything in late 2022 and 23 because there was no end in sight to the rate increases, right? We looked at the Fed, their projections, and yes, the curve just kept going up for the Fed funds rate. And we said, this is going to be a year and a half. Let's take the time to make sure our house is in order as much as it can be so that we are in an even better position and better prepared to take advantage of opportunities that will come when there is, what I'll call interest rate clarity, which I think there's a fair degree of that right now. And at this time, we're screening deals, looking at deals like we haven't done since 2021 or 2022 rather. So there's opportunity based on all the things that I mentioned earlier, and we're seeing those things, those opportunities sort of shake out of the trees.
What does your crystal ball tell you right now about, one, interest rates, two, asset value repricing?
I think you hit the nail on the head earlier, where if you bought something in 21, 22, 23, and you have debt on it, yes, the values have been hurt by your cap rate, right? Purely by that, which is a function, of the interest rates that you have to pay. And looking forward, I see the Fed, all the Fed governors are pricing in, cuts going forward. When and how much is debatable, right? That debate is going on right now, where people expected to see a rate cut in March. I think the probability is about 30-something% now, so it's getting lower and lower and lower. But if you have perm debt on your properties, at least say 5 years, right, you have some runway to improve your operations, try to increase your rents in any way, shape, or form. And looking at the expense side, try to operate your property as inexpensively as possible to create the most value out of it. And looking forward, I would say if you have 2-3 years left, even longer, 4 years left on your perm loan, I think you're in a pretty good spot to ride it out and let the economy do what it's going to do and just focus on operating your property as well as you can.
Yep. Well, the only caveat to that is that there's been a lot of cheap debt and a lot of bridge debt placed on properties. So I guess, are you placing bridge debt on properties right now, or are you placing fixed rate perm debt?
We are looking at bridge debt for some acquisitions. We sort of see the interest rate environment as, okay, we think there's a low likelihood that rates will increase anymore, right? Everyone's talking about cuts. So what we're doing is pricing in our models the bridge interest rates as they are today. And we're also pricing our perm interest rates for an exit once we finish the renovation on a property at today's interest rates. I'm not putting an interest rate cut into my model. I'm not saying, well, interest rates today, let's say, are 6.75. So I'm going to put a 6.25 rate in there because everyone's projecting it to be that way. So we're being conservative in that way. If rates come down, it's only beneficial to us. And we're basically betting by reading the tea leaves that rates are not going to increase. Now, going back to the bridge debt, which is floating, there's a lot of conversations about rate caps. They're very expensive right now, but we are looking at rate caps as well, just to mitigate risk.
Yep. No, I think it's important. I could talk hours and hours and hours about rate cap pricing, and you're mentioning 2022 or 2021, 22 rate caps were not even they're a rounding error when you would pick them up, and now today they're multiple hundreds of thousands of dollars, and there's a lot of pain being felt if you've got to go renew one. So it's going to be very interesting times ahead. With that being said, we like to dive at the end of the show into the top 5 investing tips. Ready to get into it?
Sure, absolutely.
Mate, question number 1 is, what's the daily habit you practice to keep on track towards your goals?
Keeping abreast of the local market, constantly reading the local trade rags and the local news to understand which way the market's going, as well as brokerage reports on the market.
Question number 2 is, who's the most influential person in your career to date?
Oh, that's a tough one. I've had some pretty good mentors in my time at various shops. I can't really pick out any one, but I would say that, anyone who is willing to teach you and point you in the right direction is someone that you should recognize the value of that person, recognize the nuggets of gold that they are, imbuing, to you, and make sure you try to learn from those people as much as possible, because you can get pretty far ahead in your learning curve by listening to someone who's been in the market for a number of decades.
Yeah, completely agree. Having those mentors around you is so key, but having multiple mentors is really important as well as you progress in your life, as you grow as an entrepreneur, as you grow as a real estate investor. So could not agree 100% more with you on that. Question number 3 is, what's the most influential tool in your business? And when I talk about a tool, it could be a physical tool like a phone or a journal, or it could be a piece of software that you just can't run the business without. What is it?
It's our property management software.
What do you use?
We use AppFolio. I can get a lot of information from, like I said, reading trade rags, etc., and talking to my partner. However, looking at the data that we've compiled over the past 9 years and being able to tell investors, here is our experience in the market, and here's the data that backs it up, and this is why we underwrite to these numbers. I don't think there's anything better than, that sort of proof or support for why we continue to underwrite the way we do and view the market the way we do.
Yeah, no, I love it. The number one thing we as real estate investors and people who raise money from other people is have to be a source of data, particularly around real estate and in the markets you invest in. So using AppFolio or CoStar or Asymmetrics or Yardi, anything that can help you get your fingertips on valuable historical data is really, really important. The other thing I would layer on top of that is having your data in real time. So what do I mean by that? Sometimes, like we look at CoStar data, I'm going off a bit of a tangent here. It's supposed to be a lightning round. It's not. Is the cap rates in certain markets. And they're saying, if you look at the data, because it's always backward looking, like the Fed is, and housing is always a backwards looking thing. But we're underwriting today market rate cap rates at 100 to 150 to 200 basis points higher than what the CoStar data is telling us where we're at today, which is very interesting. So having the historical data is really important, but then having your real-time data of what's happening when things are shifting so quickly. And that's what's happened in the last 18 months. So keeping a good data set of your own is really, really important. So enough of my rant. Question number 4 is, in one sentence, what has been the biggest failure in your career, and what did you learn from that failure?
I would have to say, and I alluded to this earlier, I took a bit of a circuitous route to get here. If your goal is to do X, well, first of all, let me back up. You want to define what your goal is, right? And try to draw a clearer, quicker path to it, whether it's going back to graduate school, reading a book, joining a mastermind, teaming up with a mentor, etc. If you want to start a property management company, go work for a property manager. If you want to become an acquisitions person who buys your own deals, try to get a job as an acquisitions analyst at a reputable firm. Because, it does take, not that I regret my experiences, but it does take a long time to build up the knowledge to be able to go raise capital, show people that you know what you're doing, and then understand how to deploy it with confidence. And I would just say, take that first step. When things are hard, take the second step. When they're hard, take the third. Just don't stop, and try to draw the line between you and your goal, and try to figure out and ask questions and ask for help all along the way, and you'll get there.
No, I love it. Love that piece of advice. Mate, last question is, where can people reach to continue the conversation that will be in your sphere? Where do they go?
Go to our website, which is SRE Ventures, VENTURES. It stands for Southgate Real Estate Ventures.com.
Awesome stuff, my friend. Well, look, I want to thank you so much for jumping on today's show. Just want to reflect some of the things that I took away from today's show. I think the importance of identifying key trends in market growth. But I think the real value of your special sauce was that you're working in a shop that you had access to. You're getting paid the most you could get paid in corporate America whilst learning on the job, and then use that data to go make investment decisions. So key to everyone out there, even if you don't have the skills or you're not in the business today, you can go and get a job in the business to continue to learn and to grow. And it goes back to what you're saying earlier, Michael, about having multiple mentors around you, about drawing that clear line from the point you are today to where you want to go, and how do you get there most efficiently. And I think that is the nuts and bolts of what I took away from today's show, is your ability to use your skill set to go and find jobs, to then use those jobs to help continue pushing that ball down the fairway, or continue taking that step every single step of the way to getting to where you want to be today, which is obviously extremely successful. Amongst everything else about having a partner halfway across the country and being, a yin to his yang and all that sort of stuff, like there's a lot of really great nuggets in here. So I thank you so much. Did I leave anything out?
No, I don't believe so. I just want to thank you for having me. It's been a real pleasure.
My pleasure back at you, my friend. I want to thank you so much for jumping on today's show. Enjoy the rest of your week, and we'll catch up very, very soon. Well, there you have it. Another cracking episode jam-packed with some incredible advice from Michael. If you want to check him out, it's sreventures.com. Go out and check out everything he's doing over in the Seattle area, buying properties and buying them at discounts and buying them from long-term owners. Check out what he is doing. I want to thank you all again for taking some time out of your day to tune in to grow your financial IQ, because that's where we're all about here on this show. The easiest way to give it a review is to give it a 5-star review on iTunes. And you can catch all these show notes on my website at readgoossens.com. Don't forget, you can also invest alongside of me in my next up-and-coming deal. Remember to check it out on readgoossens.com. We're going to do this all again next week. So remember, be bold, be brave, and go give life a crack.